What's up guys, welcome back to the Daily Stock Picks, and in this video we'll be going over 7 strong stocks that you don't want to miss out on according to this article by Investors Place. So what I'll be doing for you guys is I'll be reading over this article with my beautiful voice, commenting, and we'll be conducting my own quantitative analyses to see whether these 7 companies either belong in our dividend portfolio or our value portfolio by using this checklist. So stay tuned. So before we head on to the video, make sure that you smash the like button for the YouTube algorithm. I would really appreciate it. Hope that this video brings a lot of value for you guys and saves you time in reading this article and give you a head start or a jump start on your analyses before you start investing in these 7 companies. So without further ado, let's get this video started. So 7 strong stocks to buy to avoid portfolio overvaluation. The stock market may be flying high, but these 7 companies are still stocks to buy. By Ian Bezek, Investor Place contributor. The stock market is off to the races, routinely notching new all-time highs from day to day. Tech stocks initially led the charge higher, but now the S&P 500 index has rebounded to reach uncharted territory as well. With these sharp moves upward, particularly in the face of a weak economy, investors are increasingly worried about valuations. That's a valid concern, but there are still quite a few stocks to buy for your portfolio today. What does a strong buy look like heading into September? 2 categories of companies stand out. The first are the firms that are seeing a slowdown due to the novel CVPD that should end quickly. Despite facing temporary problems, their stock prices remain well below pre-CVPD levels. Second, we have companies that are seeing an increase in business activity thanks to quarantine and work from home trends, but whose stock prices don't yet fully reflect this momentum. Added up, you end up with these 7 stocks to buy. Let's take a closer look at these portfolio powerhouses. The first company in this list is NASDAQ, ticker symbol NDAQ, right? So if you're like many investors, you want to own more tech stocks, but the lofty valuations make you worried. Our first strong buy stock can deal with that problem. The NASDAQ Stock Exchange is in fact a publicly listed company which we can invest in. NASDAQ earns revenues from a variety of sources. There's trading fees, of course. You also have fees for corporate events such as initial public offerings and secondary stock listings. NASDAQ has a large and rapidly growing data businesses where it sells market information to high-frequency trading firms and hedge funds. Also, NASDAQ has some software business related to these other lines of business. Put it all together and you have a strong buy. NASDAQ serves a vehicle to profit from the overall tech boom. As more and more companies go public on the NASDAQ and trading activity picks up, NASDAQ will naturally make more profit. And as the market surges, the value of the company's proprietary data spikes as well. If you view these high-priced tech stocks as a gamble, the NASDAQ is the casino. And as they say, you always want to bet on the house. At just 22 times forward earnings, NASDAQ stock is an attractive way to play the tech boom. Okay, so let's have a look at NASDAQ, NDAQ, that's the ticker symbol. Looking at the price to earnings multiple, it's 27.56, which is lesser than the broader S&P 500 index, right? And in order for a company to meet my dividend portfolio, it needs to meet 4 rules of mine. These 4 rules are something that I picked up and I've changed and modified based on these 3 books. The first book is Dividends Still Don't Lie by Kelly Wright. The second book is Get Rich with Dividends, Mark. And the third book is The Ultimate Dividend Playbook by Josh Peters from Morningstar. And these are my infamous dividend portfolio rules. The rule number 1 must be met, right? So we want to be making sure that the free cash flows are positive, which basically means that we're making sure that the company is bringing in actual cash rather than just representing money in the income statement as net income, right? And rule number 2, dividends paid out should not be more than 75% of the current free cash flows. Since this portfolio is purely based on dividends and the consistency of the dividends, we want to be making sure that the company is not paying out more than 75% of its free cash flows, because we want to be making sure that the company does, and the management at least has 25% of the free cash flows to invest it back into the business, or otherwise prepare for a storm, because you never know what the future entails, right? And rule number 3 is that it needs to have a consistent dividend growth history of at least 5 years. If you want to be on the more conservative side, I would recommend checking 10 years, right? And rule number 4 is the buy criteria. So we will only be entering the stock when the current dividend yield is greater than or equal to the 5-year dividend yield average. More on that as we move along with this video. So what I like to do is I like to look at Y charts, because they do a really good representation of the financial information in a visual aspect, rather than looking at bland numbers on the financial statements, right? So the revenues, we can see that it has been increasing along with its free cash flows. So the free cash flows, you would say it was around $400 million 10 years from now, and it would have nearly doubled. So around 10% year over year compounding annual growth rate. Now the NASDAQ does pay out a dividend of around $305 million. So the free cash flows are positive, definitely. Let's see, $305 million divided by 836. That equates to around 36% of the free cash flows. And the remaining 65 odd percent, or 60 odd percent, can be retained back into the business, which is showing that it is not paying out a substantial amount of free cash flows, and the management does have sufficient amount of money to prepare for the future, right? Now let's see how long NASDAQ has been increasing its dividends. NDAQ. Okay, so looking at this, NASDAQ has been increasing its dividends over the past 8 years at a rate of 26.11%. So definitely meets the criteria. And I want to focus on the 26.11%, guys, because a lot of people and dividend investors take it lightly. So it's basically like you going for work, and just for going to work, right, and doing your regular work at a daytime job, the management or the company is increasing your salary on a 26% basis year over year for doing the same thing, right? I would interpret it as that. And 26.11% is pretty phenomenal, and it'll compound the investments if you do decide to reinvest the dividends back into the company to boost up the compounding effect, right? And looking at the dividend yield history, let's see if it is a right time to buy this company at the current valuations. So the current dividend yield we can see is 1.44, and the average dividend yield is 1.74. So we want to be buying the stock when the current dividend yield is more than the average, because we don't want to be paying too much for the stock, right? And just for example, I know that we missed a chance here because it spiked somewhere around March, right? Let's just say we were able to catch it at the right time. This is where all the tickers and the alerts that you can set in Google Sheets really come into picture. You can actually create an alert to see if the dividend yield reaches that particular stage. Then you can immediately start to buy that stock when it hits those levels. So let's say, for example, you invested in this company back in March when the dividend yield was around 2.58%, right? If you were to look at NASDAQ around March, you can see that NASDAQ was at most likely an all-time low of $72, right? And within a span of 4 to 5 months, it nearly doubled, and it's right now trading at $131.84. So don't take this strategy lightly, guys. I know that we missed a chance with NASDAQ as a dividend portfolio, but you never know what the future might entail with the current economic situation and the CVPD situation escalating in many countries, right? Now, since it doesn't meet the dividend portfolio, we can definitely see if it meets the criteria of the value portfolio. In order for a company to meet my value portfolio, it needs to make sure that it meets 5 rules, right? And these 5 rules are based on these books that I read. The first book is The New Buffettology by Mary Buffett and David Clark. Mary Buffett is the daughter-in-law of Warren Buffett, or used to be. And the second book is Rule Number 1 by Phil Town. And the third book is The Little Book That Still Beats the Stock Market by Joel Greenblatt, where he goes over his magic formula. I would highly recommend checking out these books in order to get the fundamentals right? And these are the 5 principles. The return on invested capital should be greater than or equal to 10. Return on invested capital is basically the profitability of the company by considering the amount of money that we are able to invest into the company in terms of its free cash flows and the debt that's being taken up by the company in order to grow its net income. And rule number 2 is that it needs to have a consistent net cash flows. Rule number 3 is that it needs to have a strong balance sheet. What do I mean by a strong balance sheet? So generally companies take on long-term debt in order to speed up the growth process, right? And we want to be making sure that the company's long-term debt isn't that substantial that it just bananas, that it takes company 20 or 30 years to clear it off. We want to be making sure that a good rule of thumb is that it needs to clear off this long-term debt within 6 years or less than 6 years, right? And rule number 4 and rule number 5 are our buy criteria. So we only want to be buying this company when the current price is lesser than or equal to 80% of the fair price. We're more on that later when we calculate the fair price by using the Google spreadsheet. And rule number 5 is, if rule number 4 isn't met, the rule number 5 is if the current price to earnings multiple is 50% cheaper than the highest price to earnings ratio over the past 5 years and should be lesser than the S&P 500 index, right? Now let's have a look. So NASDAQ, NDAQ, the return on invested capital is not exactly 10%, but if the fundamentals are really strong, I would be consider looking at this stock. And the NASDAQ revenue has been growing consistently. We know that it's been paying around 32% of its free cash flows and around 10% year over year growth rate in terms of its cash flows, or what I like to call it as bottom lines. So the free cash flows are definitely a hit. And the balance sheet. So it has a total of $3.482 billion in long-term debt, which it can easily clear off its current asset levels. So current assets are basically the assets on the balance sheet that can be liquidated or converted into cash within 12 months or less. So they're the most liquid assets on the balance sheet items, right? So it should be able to clear it off instantly, so 0 years, right? If the management chooses to do so. So definitely a strong balance sheet. Now let's see if it meets our valuations. The price, earnings per share is $4.78. Now we need to see at what range NASDAQ stock has been trading over the past 5 years, right? The lowest was around 15.74. The highest is around 116.42. And the analysts are estimating that the NASDAQ stock should be growing at a rate of somewhere around 8.81%. So what we are doing here is we're taking this earnings per share 10 years from now by multiplying with this growth multiple. And once we arrive at the earnings per share, we need to be multiplying with the price to earnings ratio of what we think that the stock might be trading 10 years from now, which is a little bit of a stretch. A general way of looking at it is that you can either multiply the analyst estimate by 2, which is 17.62 in this scenario, or we can consider the 5-year price to earnings ratio, average one, which is 66.08. So whenever we're considering this multiple, we want to be on the most conservative side because we don't want to overshoot the estimate that we're completely wrong. We want to undershoot it, and even if it does perform really well, hey, we have a really good upside for it, right? Now, for this reason, we'll be considering the earnings multiple as 17.62. the intrinsic value 10 years from now, or the stock price, would be somewhere around $180.07, and the fair price at which we should be buying the stock, considering a 15% year-over-year return, that's my minimum requirement, is $51.19. And we should never buy a stock at its fair price. We want to be buying it at a discount. So the ideal discount is 50%, which is $25, or we can consider buying it when it's at 80% of its free cash flows of at this particular price, or at a 20% discount, right? So we should be considered buying the stock at $40.95, which is definitely not the situation here, because it is overvalued at the moment based on this particular valuation. And we can use this fifth principle, where the current price to earnings multiple is 50% of the highest one. So if you look at the 50% of the highest price to earnings multiple over the past 5 years, we can see it's 58.21, and the price to earnings multiple currently is 27.56. Since it is lesser than the 50% of the 5-year average, this does meet the criteria, and it is trading a little bit below the S&P 500 index. So as a result, take it what you may, you can consider buying the stock as in terms of okay, BA3. We're trying to get the price for NASDAQ stock here. NDAQ. I don't know. Google Sheet is having some sort of problem fetching this ratio. So definitely a value portfolio belongs to our value portfolio by using rule number 5. So I would be a little bit cautious on this one. You might need to read into the company and do a little bit of research on its annual statements to see if the company does have a competitive advantage. But looking in terms of its numbers, it does meet the value proposition, but by a stretch though. I would want to see the return on invested capital more than 10%. If you do want to invest it, you can invest it in terms of a value perspective, but I would recommend holding off for now and see what the other companies have to offer. Yep. Alrighty, now let's head on to the next company. Next company is Stryker, ticker symbol SYK. One category of strong stocks to buy now are high quality businesses that have sold off due to a temporary revenue disruption. Stryker falls squarely into that camp. The company is a leading producer of medical devices for a wide range of problems. Stryker has historically been a huge winner, with the share price increasing 600% since the turn of the century. However, shares have stalled out this year, and that's not surprising. After all, hospitals deferred most elective surgeries throughout much of 2020 thanks to CVPD. A hip replacement, for example, was not deemed a priority treatment when hospital administrators were worried about a flood of pandemic patients. Without those elective surgeries, Stryker's profits have dipped, but naturally, they'll come back as strong as ever. You can delay those elective surgeries for a few months, but ultimately they're gonna happen. And with America's aging population, the demographic tailwind for medical devices are strong. People will be spending more and more money to improve their quality of life in the years, and Stryker will be a prime beneficiary of this. Okay, let's have a look at Sky. We can see that the price to earnings multiple is 47.09, which is definitely on the expensive side when compared to the S&P 500 index price to earnings multiple of 30.16. Now let's see if this company meets our dividend portfolio, SYK. Okay, so it has been paying out dividends, so that's good. The revenue has been increasing. The free cash flows, on the other hand, hasn't moved that much, which is less than a 5% year-over-year compounding annual growth rate. Because 10 years from now, it was around $1.365 billion. Now it's 1.542. Maybe at its peak was around $2 billion. Not exactly a single double to equate to 10% annual growth rate. And the dividends that are being paid out is $778 million. So the cash flows are definitely positive. Let's see if the dividends are well covered with the free cash flows. 1.542. So around 50% of its free cash flows are being paid out as dividend. So it definitely does meet the criteria here. We can see it has been paying out dividends consistently for a couple of years. Let's see if it has been growing its dividends though. For this SYK, type that in. Wow. Okay. So this belongs to a special category of a company called the Dividend Aristocrats, which have been increasing its dividends over the past 25 years. Currently, it's been increasing its dividends for the past 27 years at a compounding annual growth rate of 30.42. Remember the check analogy that I've been talking about? It's even better for this company. It's around 30.42%. And I don't see any time slowing down in the next coming 10 years or so. Now, let's see if it's the right time to buy at this company, looking at the dividend yield. So looking at the dividend yield, you can see that the company is at around 1.13, which is a little bit higher than which is lower than the dividend average of 1.17. It's not that much of a stretch because it's only 4 points, 0.01%, 0.04% in terms of its variations. I would recommend that you can consider buying this company at the current valuation because it is pretty close to its average dividend yield, right? So SYK, Google Finance, take that out. We want to be taking the price of the stock. So dividend portfolio, definitely. Just for fun, right? If you were to invest in this company back in March when the dividend yield was at its peak at 1.69, $126. So you would have made around 50 to 60% return on your capital appreciation if you invested in the stock back in March. Looking at the current valuations, you can still consider buying the stock because it's not that off when compared to the dividend yield, right? And now let's see if it meets our value portfolio criteria. So the ticker symbol is SYK. The return on invested capital has been fluctuating pretty substantially. It's not over 10%, which I like to see. But rest assured, let's have a look at the other fundamentals as well. We already analyzed the free cash flows, hasn't been increasing that much lately. I would say the cash flows are pretty positive. Now let's see if the balance sheet is pretty strong as well. So the long-term debt is $12.92 billion and the current assets is $12.8 billion. So it should easily be able to cover out this out. And if it wants to pay it out, it can clear it off within 1 year. So it does have a pretty good, strong balance sheet. Now let's find out the intrinsic value. The earnings per share is 4.21 and the company has been moving at a price to earnings multiple of somewhere around this average around 41.83, and the analysts are estimating that this company should be able to grow at around 5.27%, right? Considering the most conservative one, it's putting the intrinsic value at $70.45 and the fair price at which we should be buying the stock is $20 per share. And the margin of safety is $10 or 16.08 if you're considering a 20% discount from the fair price. As a result, it doesn't meet this, and the price to earnings multiple, it's not even trading at its all times, at least a 50% discount from its highest, because its current price to earnings multiple is 47.09. As a result, it doesn't meet our value proposition. But if you were to invest in this company, you can do a little bit of research and considering as a dividend portfolio, because of its amazing dividend growth of nearly 30% year over year for the past 27 years. Now, on to the next company. So General Dynamics, GD. General Dynamics is another such high quality company that has sold off on the short-term noise. The company, for those unfamiliar, is a leading military contractor. It's arguably most well known for submarines, though it makes tanks, munitions and a wide variety of other such equipment. That business is sound and recession proof. The US military is always going to be good for its builds regardless of what the economy does, and General Dynamics contracts tend to play out over many years or even decades, or short-term political swing won't destroy the business economics either. However, around 25% of General Dynamics sales come from private jets. As it makes the Gulfstream brand, the investors have dumped anything related to aviation thanks to CVPD. That might not be the right call here though. Private jet travel is a much different thing than commercial flights after all. The infection risk is far lower. In fact, more wealthier people may switch from first class to private jets in their efforts to socially distance away from the masses. In any case, General Dynamics is now going for just 13 times its earnings. That's very cheap for a company that consistently grown its earnings and dividend payments for decades in a row. General Dynamics is a strong buy, blue chip holding right now. Okay, General Dynamics, so we can see that it's already been paying out its dividend. Compared to the rest of the market, it is at a 50% markdown when compared to the entire market. At its price to earnings multiple of 13.52 when the S&P 500 index is around 30.16. GD, $39 billion. So it has been floating over here. So the revenue is not like a straight trajectory. There are some undulations, as well as the free cash flows, $2.616 billion. It has been falling over the past 10 years, which is definitely not a positive sign to see, but we can still see that the free cash flows are positive for now, and the dividend is equating to 1.152 divided by 1.994, around 57%, which is lesser than 75%, so definitely yes. And now let's see how consistent it has been growing its dividends. So GD has been growing its dividend, has been paying dividends basically for 1990, and it's been growing its dividends over the past 26 years. So it belongs to the dividend aristocrats, and it has been growing its dividends at a rate of 10.35%. Okay, so definitely meets the criteria. And let's look at the current valuations. GD, to see whether it is a good buy at the moment. So the current dividend yield is 2.78, which is definitely higher than the average 5-year dividend yield. So as a result, it definitely meets our criteria to belong in our dividend portfolio when compared to the other picks that we've had a look at, right? Because there was a little bit of discrepancy, or like near that, but they haven't been reaching the particular stage at all, right? It hasn't been like a sure shot like this one, which is 2.78, and the average is 2. So definitely meets it by 0.78%, right? Now let's see if the company meets our value portfolio as well, just for fun. Now let's have a look. GD, return on invested capital, definitely a positive, above 10%. So I would be really interested in this one in terms of a dividend perspective, because it is pretty profitable, right? And the revenues, we know that the revenues have been falling, but the dividends are well covered though. Now coming to the balance sheet, the net cash flow is positive. Yep. Now coming to the balance sheet, it has around $14.59 billion in long-term debt, which it should be able to easily clear it off instantly in 0 years if the company chooses to do so, because of its current assets of $21.14 billion. So definitely a strong balance sheet. and the price should be less than 80% of the fair price. So looking at the earnings per share, we can see that the company's EPS is 11.26, and the range of the PE multiple is 8.898, 24.08. Okay, so the analysts are estimating that the company should be growing at somewhere around 3.88%, right? And the intrinsic value would be around $123.08, and the fair price that we should be buying the stock should be around $35, and margin of safety, ideal margin of safety, is around $18, and the 20% markdown is $28. It definitely doesn't meet our current valuations, as it doesn't meet the rule number 4 or rule number 5, so we can exclude it from our value portfolio, but definitely a good buy in terms of our dividend portfolio, right? Now let's have a look at the next company, Reynolds Consumer Products, ticker symbol REYN. Reynolds Consumer Products isn't a lot of people's watch list yet, but the kitchen products company should be. Reynolds is the maker of its namesake aluminum foil, along with numerous other products for the kitchen. It also produces trash bags, foam plates, and other related items under the brands Hefty and Presto. Okay, what makes Reynolds a strong buy now? For one, it just did its initial public offering in February and thus is under the radar. It is going for just 17 times forward sales, that in comparison to 25 times or more forward earnings for most of the other companies, which have enjoyed a short uplift from panic buying around CVPD. Numerous Reynolds products are finding more usage as people become accustomed to cooking at home rather than eating at restaurants. Last quarter, Reynolds grew revenues 4% even despite it stopping some low margin store brands, manufacturing businesses. Going forward, it offered upbeat guidance for a full year thanks to both higher demand and stronger profit margins. Reynolds doesn't sell a lot of glamorous products, but the company estimates that its products are found in more than 90% of American households. And with home cooking still up on the upswing, Reynolds, which also already sells for just 17 times earnings, should enjoy strong earnings growth for at least the next year. Okay. REYN, let's have a look. The current price earnings multiple is 29.1, and the S&P 500 index is 30.16, so definitely a tiny bit cheaper than the S&P 500 index, not a lot. Let's see if the company does meet part of our dividend portfolio. They did say that it's a really recent company. I would want to be looking for companies that have at least a 10-year history so that we can do our analysis thoroughly. Since this company doesn't pay out any dividend, it definitely doesn't meet our value dividend portfolio at all because of its lack of dividends, but we can see if the company meets our value proposition and the growth proposition. REYN. The return on invested capital, not that attractive. Okay, the free cash flows are positive, I can give it that. $350 million, so it has been losing money over the span of from 2016, and the total long-term debt is 2.4443 minus 1.094. It's around $1.3 billion, right? And it's bringing in around $300 million as from its free cash flows. So 1.3 divided by 0.3, around 4.33 years. Okay. It's a little bit of a stretch, so it is okay in terms of the strong balance sheet part. Let's see if it meets the valuation. So 1.425 is a trailing 12 months. REYN. The price to earnings multiple, it's not over the span of 5 years, it's just recently. 22.01, 30.19. Analysts are estimating that the company should be growing at somewhere around 18. That's putting intrinsic value at around $45 per share. The fair price to be $12.96. The margin of safety is $6.48, and the buy price that we should be considered buying is around $10. So it definitely doesn't meet our criteria, and more on top of that, it's a relatively new company. We want to be looking in companies that have a really good history, right? At least a 10-year, a decade worth of information, so that we can analyze by using these principles. So as a result, Reynolds Consumer Products might be across 90% of all the American households, but it doesn't meet the criteria, and it does need some time for it to grow so that we can get the fundamentals and everything and analyze it accordingly, right? And the next company in this list is Diageo. Ticker symbol DEO. Sticking with staples, we have British beer and liquor producer Diageo. It makes Guinness beer along with Bailey liquor, Smirnoff vodka, Don Julio tequila, and many other assorted brands. The company has also made a splash recently, acquiring several celebrity spirits companies. It famously paid $1 billion for George Clooney's Casamigos premium tequila a few years ago in a deal many analysts thought was too rich. However, it has paid off. Casamigos posted stunning 68% revenue growth in 2019, keeping up its torrid rate of expansion. Diageo recently added to that, paying up $610 million for actor Ryan Reynolds' Aviation Gin. Aviation is an ultra premium gin that has been growing at more than 50% per year and accounts for roughly 40% of the entire category growth within the super premium gin category. In this way, Diageo is adding fresh and fun new brands to its stable of mature, proven labels. As for Dio stock, it's on sale now. It traded far as high as $180 last year, with bars and restaurants temporarily shut down. Diageo has lost sales momentum and shares have sunk below $140. However, over the long haul, liquor is a recession-resistant business. Alcohol consumption is not particularly tied to economic conditions. Thus, as soon as restaurants reopen, look for Diageo to shoot back up, particularly since at-home liquor consumption figures have been strong throughout the pandemic. Traders have overly punished Diageo for a very short-term blip in earnings. Okay. Let's see if Diageo meets our dividend portfolio criteria. So it has been paying out dividends, but I don't think that it's been growing its dividends some. That's the thing here. So Diageo price to earnings multiple is 42.52, which is definitely on the expensive side when compared to the S&P 500 index of 30.16. So free cash flows, definitely. The cash flows are positive. Now let's see how much this equates to. So we can see that the dividend that it's paying out is $2.075 billion, which is more than the current free cash flows. As a result, I don't want to be looking any further in terms of dividend portfolio or value portfolio, because it is currently paying out more than what it's earning at the moment. Look, it might change if the economic situation turns back up, because back in 2019, the free cash flows was $3.36 billion, and the amount of dividend that was paying out, 2.101 minus 3.336, it was around 1.235. So it would have been paying out divided by 3.336, 62% of its dividends. Due to its current valuations, I wouldn't be looking any further in terms of its dividend or value portfolio. On with the next company. So public storage, PSA. Public storage benefits from two different strong trends at the moment. The first of these is that America is currently enjoying a housing boom. Thanks to the pandemic, people are not satisfied with their living conditions. As a result, plenty of folks are moving. Much of it is from apartments to houses, though many people are abandoning cities altogether and moving to less populated parts of the country. When people move, they have to deal with all their stuff. In many cases, folks rent out storage to serve as a third place to keep their belongings while they are making a transition. The storage industry got a boost out of the financial crisis as many people changed their living situations. A similar effect should happen now. This brings us to the second point. Public storage is a real estate investment trust, REIT. Most real REITs this year have gotten hammered. Whole segments of commercial real estate such as malls, offices, shopping centers, and students' housings are under fire thanks to the pandemic. Yet many investors rely on REITs for strong dividends. With so much of the REITs universe now being a bad investment, this leaves dividend-seeking investors in a bit of a bind. Fortunately, unlike, say, malls or offices, storage is enjoying a tailwind due to the current economic events, and public storage continues to pay its 4% dividend rain or shine. Unlike so many REITs, there's no discussion of any dividend cuts here. Thus, there's an easy path to outperformance for PSA stock going forward as quarterly earning numbers pick up and investors circle around a strong REIT within a struggling broader sector. Okay. PSA. It's PSA, right? Yeah. Public storage. So it's about the same price to earnings multiple when compared to the entire market. Now let's see if it belongs in our dividend portfolio. So the revenues have been increasing. The free cash flows 900 hasn't doubled, maybe around I would say around 3 to 8% year over year increase in its free cash flows, and the amount of total dividend that's being paid out is $1.609 billion, which is higher than the current price. The free cash flows are positive, but the dividend that's being paid out is more than 75% of the free cash flows. I know some of you guys might be thinking this is a REIT, they have a different structure when paying out dividends, but I like to be on the conservative side and try to avoid these sort of companies that are paying more than the current free cash flows. So as a result, PSA doesn't belong in our dividend portfolio based on these valuations, right? Now let's have a look at the next company. So Goldman Sachs. Finally, we have Goldman Sachs. Look, I know banks are controversial at the moment. The financial sector obviously bombed out in 2008, and people are worried about a repeat. And sure, some banks will definitely face difficulties this time around as well, but many banks will be fine or even do better as a result of this crisis. Goldman Sachs is in the winner's circle. Its business is heavily resilient on investment banking. Thus, all the market activity makes Goldman stand out among the banks. Just as the Nasdaq exchange is riding the rising tide of tech activity, Goldman gets more and more fees as companies use it to launch IPOs, executive mergers, and engage in other such corporate activities. Additionally, in stock markets, Goldman's in-house discretionary traders can generally find more profitable opportunities. Goldman stock still sells for just 9 times the forward earnings multiple. Even more importantly, is selling for a discount to tangible book value. Okay, so that's the value you'd get if you sold off all the Goldman Sachs assets, paid off all its debts, and wound down the business. It's extremely rare that Goldman Sachs sells for a discount to tangible book. In fact, usually it trades at something like 30 to 40% premium to this figure, which implies 50% upside for Goldman Sachs stock as economy normalizes in the coming months. So Goldman Sachs, let's have a look. GS to see if it does belong in our dividend portfolio. Looking at the price to earnings multiple, we can see that it is at a 50% discount when compared to the rest of the market. That's good. Revenue, not good at all. It's been decreasing. Free cash flows on the other side have been increasing from minus $6 billion to 15.43, but it's been all over the place, right? I don't see any consistency over here, but nonetheless, the current free cash flows are positive. Let's see how much the current dividend yields accounts to. Around 13%, which is really good when compared to the cash flows that it's able to generate. So around 15%, the remaining 85% odd can be reinvested back into the business in order to increase its top line and bottom line, right? Now let's have a look and see how long Goldman Sachs has been increasing its dividends. Okay, Goldman Sachs has been increasing its dividends over the past 9 years at a rate of somewhere around 14.73 to 13.02%. So definitely meets this. Now let's have a look and see if Goldman Sachs is the right time to buy this company right now. So the Goldman Sachs current dividend yield is 2.41%, which is higher than the 5-year average of 1.55. So definitely Goldman Sachs, in terms of a dividend proposition, is a buy at the moment because of its current valuations. Just for fun, let's see if it meets our value portfolio as well, right? Because in our value portfolio, we'll be doing a little bit of balance sheet magic as well to see whether it has a strong fundamental. I want to just get a full picture of this company, right? Goldman Sachs, 2.28, but that's pretty common when compared to the banks. The return on invested capital is pretty less when compared to the broader market because of that particular reason. Just to prove the fact, let me show you the comparison of how that is. So if you were to look at Goldman Sachs, company, and its peers, Morgan Stanley, JP Morgan and Chase, Bank of America, if you were to look at its return on invested capital, it doesn't show that metric though, but return on equity and the return on assets are somewhere around the same price range because they can't produce that much of a return on invested capital of more than 10%, right? Because of this, it is okay. It definitely does meet the rule number 1 of the criteria, but we can still look at the other aspects as well. Net cash flow is definitely a positive. And the total long-term debt is $292 billion with a B, and the total current assets is $376 billion, which it easily can clear it off instantaneously if the company chooses to do so. Now let's see if it is trading below its intrinsic value. The current EPS is 13.32, and the range at which the price to earnings multiple has been trading is 6.427, 31.75. Analysts are estimating that the company should be growing at somewhere around 6.29%. So looking at the value proposition, we can see that the price at which we should be buying or considering buying the stock should be around $64.99, which is way below the current market price. But definitely we can have a look at the other prospects as well, right? The 5th rule, definitely the 4th rule did not meet, but the 5th rule, the current price to earnings multiple is 50% lower than the highest price to earnings multiple, right? Of the 5-year average. So if you were to divide 31.75 divided by 2, it's 15.875. And the current price to earnings ratio is 15.8. And it is definitely cheaper than the S&P 500 index. So you can still consider this as a value proposition as well, as it meets our 5th rule of our checklist. Okay, so out of these companies, the company that I believe is the best for in terms of a dividend perspective is GD for sure, because its dividend yield is bananas at the moment. And these are the 4 companies, 4 out of 7 companies that seem to be attractive. So I would recommend that you guys do a little bit of research to see whether you want to go ahead and pull the trigger and buying these stocks. they have a really good moat in terms of this checklist perspective, right? So Ian Biskin, the closing remarks of this article. So Ian Biskin has written more than 1,000 articles for investorsplace.com and Seeking Alpha. He also worked as a junior analyst for Curacao Capital, a $300 million New York City-based hedge fund. You can reach him on Twitter at IRBizek. At the time of this writing, he owned NASDAQ, GS, PSA, DO, REYN, GD, and SYK stock. Okay. So if you guys have stayed around till the end of the video or this part of the video, I truly appreciate it. Thank you guys. And full disclosure, this video is for your education and your entertainment purposes only. There is no guarantee that you will earn any money using the techniques and ideas mentioned in this video. This is not financial advice. Please consult your financial or tax professional prior to making an investment in these companies. So if you guys feel like being awesome, make sure that you smash the subscribe button and turn on the bell notification icon so that you can get notified as soon as we post new videos. So we post new videos from Monday to Friday. So stick around. And thanks for watching. Catch you in the next video. Peace.